Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Mike Zlotnick. Mike has been in the has been a debt and equity investor in the real estate world for more than 2 decades. He started his career and had spent nearly 15 years back in the information technology field, where he managed risk, handled business intelligence and quality of complex systems, and managed software and processes. Now, back during his IT career, Mike's passion had always been real estate investing because of the predictability of outcome and well understood risk. And so, Mike, fast forward today, Mike currently holds the title of CEO at TF Management Group. And under Mike's leadership, the company has seen transformation and growth, delivering strong returns for their fund investors. And guys, so with that, I'd like to welcome back. It's been a couple of years, but I'd like to welcome back Mike Zlotnick to the show. Mike, how you doing today?
Kevin, thank you so much for having me. I'm doing great. How are you?
I'm doing great, man. Excited to have you here. Excited to talk shop. I know that we had a very brief opportunity to we ran each other at an event a couple weeks ago, but didn't really get a chance to really catch up. So excited to have you here. And as I was telling you before we started recording, that sometimes a month goes by or a year goes by, and it seems like it's just a blink of the eye, and that's ultimately what happened. I was looking back to see when I had you on the show last time, and if you would have, I'm not a betting man, but if I would have bet on it, I would have said it was sometime in 2023, but sure enough, it was 2021, right in the heat of a very unique time in history, during the pandemic. But 2021, real estate was already on fire. Things were going crazy, and but just very different time than where we're at today. Rates were at a all-time historic low, and now we're at an all-time historic, not necessarily high, but the rate that they went up was historic in and of itself. And so just unique time back then, unique time today. And so I'm excited to get caught up with you and just find out just really what you've been up to. What's maybe different in your business today, some strategic changes that you've made, and just again, just talk about where we're at and what the future holds for us. So, but with that, Mike, what I'd love to do, for those that maybe aren't familiar with you, didn't listen to the past interview, haven't heard you in other shows. I know you've done quite a podcast and you're out there. But for those that don't know your story, a little bit about you, if you would. So give us a little bit who you are, Mike, and what it is you do.
Thanks, Kevin. Yeah, I'm a real estate investor by passion. That's sort of discovered it. Let's call it in 2000. Been a passive investor since 2000 till 2009. Went full time 2009. Never looked
Mhm.
back. So, but I'm a mathematician by education. Grew up in the former USSR. Left USSR when I was almost 18 in 1989.
Mhm.
Came to the States, U.S. citizen, U.S. patriot. That's it. Just run family of funds and syndications. We call it Temple, family of funds and syndications. Live in Brooklyn, New York, four wonderful kids. I call it four monkeys and a cat. I actually have a cat, my wife and a cat. And just focus on only real estate. I'm a one-trick pony. But what we do a little different from a lot of other folks. You specialize in mobile homes.
Mhm.
We specialize in finding the right operators, right strategies, and diversifying for investors.
Mhm.
So what we are sort of capital allocators, funds that diversify. We focus on different strategies like income, like cash
Yep.
flow. We certainly love that strategy. So
Mhm.
that's about it, high level. And also people call me Big Mike, as you know. Cheesy name. I run a podcast called Big Mike Fund
Yeah.
Podcast.
It's a great show, by the way. And how'd that name come about? Come on, folks surely are asking themselves, Big Mike, how'd you get the name? Just you are tall. Is there anything? Is that what it is, or is there something else around it?
Well, it's not. I'll start with a joke. I usually end with this joke. So I'm not going anywhere kinky, but if you go to bigmikefund.com, I promise it's not a kinky site. So it's actually bigmikefund.com, but I also
Yeah.
own bigmikefund.com. There's no you know no kinky stuff. Let me put it this way. It's literally a collective genius mastermind. You said Scott from he used to be in CG.
Mm-hmm.
Met many other great guys, and they called me Big Mike. Hey, Big Mike, because I'm 6'4", a little on the heavy side, so that name stuck. And I couldn't come up with a more creative name. Literally goes back to the first person on my podcast, the one who well actually helped me set up Corey Boatwright.
Mm-hmm.
You might probably know Corey. He
Yep.
just said, "Won't you call the podcast Big Mike Fund Podcast? You're a fund manager." He goes, Big Mike. That's the cheesy story.
Done. No, I love it. I love the KISS methodology. Keep it simple, stupid, right? Just I love it. I love it every bit about it. So Mike, you'd mentioned you kind of went all in I think it was 2009 you had stated, but prior to that had started investing passively back in 2000 and just what did that pivotal moment look like? I mean, sure leading up to 2009 there was consideration along the way, but what ultimately made you just finally pull the trigger and say I'm going all in on this thing?
Yeah, I stayed in IT. I was a successful technology executive, actually running multiple departments, VP, director, various corporations. Some were pretty successful. I was burned out, honestly. I was just tired. The field is a great field, but it required a lot of late nights running teams globally distributed. Not to bore you, having successful career, I really thought real estate was so much more fun.
Hmm.
And investing is always fun. If you invest passively and then you invest the right way, it kind of works for you. You
Yep.
sleep and the money works for you.
Yep.
So I kind of discovered that passive investing, and then 2009, sort of the transition was almost natural. I was burned out, tired, and my friend started Original Temple Funding, and he kind of didn't want to run. He's a technology executive too. He said, Mike, won't you go run it? You love this stuff. So we started to fund short sale flips. If you remember 2008, market
Hmm.
crashed, a lot of short sales. A lot of properties were upside down. People would lock it up for 300 grand, flip it for 350, and they needed funding for 1 day. We did a bunch of that short-term funding, and returns were great. You can charge 1.5, 2 points for a couple of days. So this is great. I love this. So we continued and we picked up the volume and we ran quite a bit until the market sort of shifted. 2011, a lot of anti-flip restrictions kicked in. The banks didn't like the fact that investors made money on them on their stupidity. So they start requiring 90-day holds, 120. So we got into hard money lending effectively. We got into lending for 90 days holds, 120 days, six months. And then we continue that business for many years forward. Lending business, a hard money lending business, is just solid. It works in any
Yeah.
market, good, bad. There's always a need for these type of loans. We still do them, but we did see a bunch of other opportunities on the way. So that's kind of how I started, by
Okay.
just a natural shift when I was burned out.
So that's still part of your strategy today at Tempo Funds,
Yeah,
Tempo
yeah,
Family Funds, correct? Okay.
we do lending, first lien lending in Tempo Income Fund. We do quite a bit. We like it. It's plain vanilla. You know
Yep.
what's been going on. You started the conversation last time we recorded was 2021. Market was hot, banks were lending, everything was great. But market shifted drastically now, late 2024. The banks are very tight, credit is very tight, rates are much higher. And what it did is it took a lot of fix and flip bank loans out completely. They were doing a little bit of this in the past, but now it's all gone.
Hmm.
So fix and flip funding, it's only hard money. It's all private credit. And then the banks vacated the space almost entirely. So at this point, it's really great time to be a lender if you're looking for income-oriented strategies, because you could charge higher rates. The rates are higher. Terms has gotten actually better for lenders. It's a remarkable time if you know what you're doing in the lending space.
I was going to ask you, what is I've been out of that space for many decades. And so is it like 12 and 2? I mean, what are the typical terms that you're able to achieve today with a hard money loan?
So primary debt, when we do first lien loans, we do 14 and 2. We
Okay.
were never
Wow.
the cheapest. We were never the cheapest. At some
Yeah.
point, the cheapest people were trading 8 to 10%, 9, 10.
Hmm.
We were always, our bottom was at 12. And then as rates climbed, we went to 14 and we didn't get any pushback.
Wow. And you'll fund up to how much of the total project cost?
So traditionally, we'll go 65, 70%, depending on the borrower. So some people go 80, 90. We generally don't go that crazy. We will do a relationship loan if we know the borrower, we know the strategy. We can
Hmm.
we can fund higher loan to cost, but loan to value has to be in that,
Yeah.
let's go 65,
Yeah.
70%.
Yeah. 65, 70, and then plus repair costs, right? Rehab
Yeah, yeah.
costs.
Construction
Yeah.
draws. So it's we do want to see skin in the game. We want to see some reasonable underwriting, and we also want to see what kind of market, steady eddy versus cyclical. Some
Hmm.
markets have gone through a lot of volatility. The steady eddy markets, so we try to work sort of much more predictable, and you
Have
know the outcome.
Yeah. Have you seen any demand? I'm down here in the the Clearwater, Tampa Bay area. Obviously, we Hurricane Helene, this whole at least a 150-mile stretch of the West Coast here, ended up with 4 or 5 feet of water in their homes. And while that wasn't that big of a deal for homes that were newer built post Hurricane Andrew, built to code, built above flood elevation, while they might have had water in the garages, not that big of a deal. But however, any of these older homes, grandfathered homes that were built, most of them it seems to be pre 1990 ish range. Again, ended up with 4 feet of water in their living space, and there's the FEMA's 50% rule has been wreaking some havoc on this area, and so you're seeing a lot of homes that just they literally can't be rebuilt. They're the cost to rebuild them and make them habitable exceeds FEMA's 50% rule of the homes assessed value, not the actual home in the real property, which the real property is the larger value if it's on the waterfront, if it's on the Gulf or on a canal leading out into the Gulf of Mexico. And so I'm just curious. I'm curious if, like, what I've been seeing is these things are getting gobbled up so incredibly fast. But I'm wondering if that's actually parlayed into, have you seen any type of demand or anything that's been creeping up as far as like rehab loans? Folks that are down here in the Gulf Coast, opportunistic investors looking to buy these distressed assets.
Yeah, I don't have any brilliant insight on this topic. We
Yeah,
don't do much here in that area, but
got it.
I absolutely heard of the whole left coast of Florida has been beaten up pretty badly. A lot of valuations. It's all sort of market by market. But we've
Yeah,
seen significant softness in the prices of real estate, although it's been very local. Some assets are trading at a big distress pricing, and some investors could be gobbling up. But you have fundamental problems or risks and concerns, right? Insurability. Can
yeah,
you ever insure them, right? Two, which houses you have to completely gut out, rebuild, which houses you can actually repair.
that's right.
So I would say this is precision, this is surgery. You can't really do this in any kind of volume. You have to be really a specialist. And we've
Mhm.
not seen anything in this. We do a bunch of stuff in Midwest and a few other submarkets, but not much where you mentioned sort of
Yeah.
West Coast.
The interesting thing, I tie it back to, to my own personal experience. Very, very different experiences, but similar sentiment is, back in '08, I lost quite a bit of real estate, just, challenging times for many, just like it is right now. Um, and I was down here in Florida, and everything went on sale. Everything went on sale, 2009, 10, 11, 12. I mean, really the recovery really didn't happen. At least I couldn't see it happening until like 14, 15 era. But everyone knows the old adage of you want to buy when there's blood in the streets, right? When there's distress. And it's really difficult to do that when you're emotionally in the mix. When you're in that bubble and it's your own distress, it's your own blood that's running in the streets, it's really hard to take a step back and understand and realize that, while you might be experiencing pain, others are saying there's a great opportunity to be had here and we're going to start gobbling stuff up. I just remember, like, I wasn't able to like get back on the horse. I had a lot of things happening, trying to run damage control and trying to just really, organize and sort through the chaos. But really didn't start buying anything until like 2011, 2012. And while what we bought was phenomenal, right? Like that was still a great time to be buying. We missed the first couple of years of opportunity. And so the interesting thing of how I tie it to where we're at today is the neighborhood I live in. We're I guess as the crow flies from our home, we're like literally 100 yards from the Gulf of Mexico. Um, 90% of our neighborhoods, low lying. We happen to live on one hump in our neighborhood, and our home's newer built. We built it up, and so but the majority of our neighborhood experienced severe flooding and a lot of loss, and a lot of close friends. All close friends had some type of impact, and a lot of them have grown up here, or maybe they've lived here a long period of time. But like we've all dealt with hurricanes. We've dealt with this shit year after year. Like some worse than others. This year, significant, right? Significant damage. But the interesting thing is that most of them that are so close to the problem that had damage in their own homes, they don't understand how anybody is like, they're like, oh, Florida real estate's going to crash. It's like, it's going to go through the tank. I mean, like, or, just go down the crapper, right? Like it's going to take a long time for it to recover. People aren't going to want to live here. People are going to be concerned that this is going to happen next year and the year after that, year after that, right? This was a 100-year flood. This hasn't happened to this capacity in literally 100 years. But with that being said, as I just told you, what I've seen, if you go on the MLS right now and you just go anywhere along the Gulf Coast, basically in the Tampa Bay area, two different counties, Hillsborough all the way down to Pinellas County, and look at any of the homes that are in the beach areas, that are in the coastal areas, they are literally going under contract faster than you can snap your finger because there is an opportunity. That opportunity is for those that are kind of they've stepped away a little bit from it, right? They can see see through the trees, see the opportunity through the forest. And again, those that are so close to it are just having a challenge because again, it's so emotionally touching for them. But anyway, just I wanted to share because that it's just where there's challenge, there's opportunity. It's not necessarily what we do, but it was just interesting to see some of the um, the relative points of how I felt in '08 and to what's ultimately happening now after the damage from the hurricane. So anyway, just figured I'd throw that out there. Don't know if you had any comments on that,
I
but
do
just
have some comments
yeah,
for
yeah,
that.
please. I'm just rambling here, but it's interesting because I've been thinking about it quite a bit. And I think the same thing ties to like what ultimately might happen after selection, and we can talk about that kind of what your crystal ball is going to tell you and what you think might what occur. But please share if you would.
Well, let me go to some fundamental points and then we can chat about crystal ball discussion. So fundamental points, be greedy when others are fearful, be fearful when others are greedy. So blood on the streets, right? So right
Yeah.
now, a lot of these properties appear to be at a steep discount. So if you have the courage and you have the resources to pick up some of these properties at a steep discount and you feel the conviction, listen, this is how the biggest bargains are found if you can do that, right?
Hmm.
That's the first point. It's a fundamental thing. Also, remember, pendulum swings, sometimes all the way to the left, sometimes all the way to the right. Ultimately, things revert to the mean. So on a historic basis, is this inflow of huge hurricanes. Maybe we may see a number of quiet years afterwards. We don't know that,
Hmm.
of course. But if things for a while the right coast of Florida was heavily impacted, now it's the left coast. So we just don't know. Maybe it's just a cycle that happens every 30 years, every 100 years. Who knows? We,
Yeah.
we just don't know that, right?
Right.
So, but Florida is not going anywhere. All these fears of ice caps melting and Florida getting flooded, that this is too far out, too many years out, too much fear mongering. There's a lot of demand for Florida. Florida is a great state, no income tax, still great climate. A lot of things are going for Florida. So that I'll just say, and I'll stop on that. If you can
Yep.
get comfortable to deploy capital, maybe great opportunities could be found today. That's one
Yep.
quick comment. And don't let the emotions sort of ruin your logical decisions. If you're
That's right.
emotionally attached to some property, you can make decisions based on pure long-term view of where the capital needs to be. But
Yep.
you have to also realize, what are you buying these properties for? Are you buying these investment properties for rental purposes, or are you buying them as a second home, or are you buying it for primary residence, right? It's a decision tree that is different for every investor. For those who are looking for long-term appreciation, they want second home, it's one decision. For those who are looking for income, can they get these properties fixed up and rented again? With so much damage, you have limited supply. It's another interesting thing.
That's right.
So the prices may temporarily dislocate and then they may recover fast if supply is limited and demand comes back. So it's a function of a lot of market forces. Just a quick commentary on that.
Yeah, no, I appreciate that. Great summary. So, we talked about lending. That's ultimately one of the strategies today. But talk to us a little bit more about what else is working, within your business today. I mean, what strategies are you guys implementing? Where are you seeing success?
Sure. So I mentioned primary lending. That continues to be our
Mhm.
core business, has been for a long, long time. And we continue to lend through our primary lending fund, Tempo Income Fund. But we also do quite a bit of what we call today opportunistic recovery capital. We call it mezz lending, secondary lien
Mhm.
lending. On the projects that raise capital, typically these are commercial projects, multifamily, just to be exact. We're
Mostly
open,
multifamily, right?
yeah, multifamily,
Yeah,
yes.
yeah.
Typically institutional quality, large properties, not single family. So we've done projects 1,000 doors, 996 doors, 561 doors, 500 with change doors. These are large properties,
Hmm.
mostly in Midwest, where the market's a lot more steady. In these steady cities like Indianapolis, St. Louis, suburbs of Southeast Michigan. And the reason I mention these things is that we're working with high quality, very, very experienced operators. But even great people still got hit with liquidity shortage,
Hmm.
liquidity
Yep.
pressure because of higher for longer interest rates. And a lot of these projects just need additional capital. Even because of the fact that the banks are asking owners to raise additional capital to reduce the risk for banks to set aside
Hmm.
interest reserves. So we found this a great niche to provide capital in the form of mass debt. The reason we like mass debt better than preferred equity is for a couple of reasons. So debt is contractual obligation. So when you write preferred equity, there can be challenges collecting payments. With
Hmm.
interest, it's due, right? You collect. If you don't collect, it goes in a default. Two, IRA investors like debt more than equity because they have no UBIT tax. And there's other reasons why debt is actually preferred. But that aside, the concept is we come in typically with a little bit of capital. If previously project had raised, let's call it 20 million on equity, large project. Now it might need another 4 million, just as an example.
Hmm.
And that capital comes in ahead of the previously raised capital, but behind primary debt.
Yep.
And it's mass debt. And the market for that money is really strong. We've seen a ton of deals. We're very, very selective and picky who we do these transactions with. But we basically can charge 20% interest rate, a couple of
Wow.
points, ask for some equity kicker on top of that. And we're picking the projects that are clearly on their path to stabilize within, let's call it a year and a half, 2 years. So they execute strong value add plan. And then they also, we expect the market conditions to improve because of the interest rate direction now. We finally, let's call it, went through the peak of the cycle, a local cycle, and we're now on the way back. At least that's what the Fed signaled.
Yeah.
So we expect some tailwind from the interest rate policy, and on top of that, projects that execute value add, renovate units, increase rents, and then they can refinance the sold in a better market. So we see this as one of the best ways to invest today. On a risk adjusted basis, it's hard to find anything better because you're basically taking it's kind of you're taking a debt position, but you're getting equity like returns
Hmm.
and taking debt like risk. That's sort of
Yeah.
the one of the best opportunities today.
And so obviously the opportunity, but I guess when I just try to conceptualize what the risk might be, it's really most of it revolves around rates maybe not coming back down, right? I mean, just trying to forecast what ultimately the Fed intends to do and are actually going to do, right? Is that the primary risk in one of these mezz debt scenarios?
Well, the few risks. I'm going to go through risks, possible risks on all these projects. Let's start with execution risk, right? So you have to pick very, very carefully who you are transacting with.
Hmm.
You really want to find vertically integrated operators with strong ability to execute, because a lot of these projects are in the middle of the value process. So it's renovations, lease up, all that has to be very strong, right? That's one of the risks. If you don't complete these projects, the value is not
It,
maximized.
and how do you determine, as far as, just validating that sponsor, who's the right one, who's the wrong one? What are some of the key aspects you look for?
So we obviously come and visit. We want to meet the team, understand
Mm.
who are the key players, what markets. We visit their property locations. Do they have warehouses? What kind of products they use? You literally can go and see how much supply do you have in a warehouse? Where do you get your supply chain? What does it look like today? Or who is working? Where do you get the crews? Are they all direct to you, or there's some kind of hired guns? Who is your construction manager? And you talk with these people, and at least you try to do as much due diligence as you can to determine whether they have strong vertical integration in each market they operate, which is a critical component of. We've seen absentee landlords. They live in Phoenix. They have a property in Atlanta, right? And then they are relying on third-party property manager.
Hmm.
We like direct property management.
Okay.
Go meet with leasing people, talk to them. Literally, we've done these visits, and we see progress with units. We see construction crews working, and then you talk to leasing people. You want to see energy capability, how they are approaching. So you're paying attention to detail of that execution of their capability, right? This is a critical element. It's not the only element. And what's really interesting is if the property is far along through their value add, there's only a little bit left, then the risk is obviously lower. If it still needs a lot of work, then we got to go see how many units they are renovating, what is the
Hmm.
occupancy, what kind of rate of delivery, what kind of rate of approval, what kind of leasing do they have, waiting lists. So we've looked at all these components to see how well they can execute. And even if there's more risk, we sometimes ask for additional collateral. So if a given property is going through heavy value add, well, what else can you put up to give us extra security because there's a lot of risk on this property? So just
Hmm.
one element of risk. Next element of risk, of course, interest rates, right? I mean, just this one of the most obvious.
Yep.
So this is a very interesting point, and most folks don't really get it fundamentally. They think, well, if the interest rates don't come down, you got a big problem. That's not exactly true. What really is true is this. Actually, think about it. Interest rates are high for a simple reason. We have a high inflation. This is the biggest way to describe it. Interest rates is a reflection of the inflation in the economy. So if inflation is high, it means generally speaking, people are working, you have good GDP, you have good employment. Ultimately, they can pay higher rents. So on a long-term basis, I don't mind high interest rates as long as the rents are going up. What I don't like to see is rapidly changing interest rates. Obviously, rapidly spiking interest rates is the worst of all scenarios. That's what we saw in 2022 March all the way through July 23. We got rates from 0 to 5.5 in a year and 3 months. That change is what dislocated a lot of projects. But if you take that away, we are already at a high level. Even if the rates stay at a high level, or they even go a little higher, the rate of change will be marginally, relatively not as bad, right? So if inflation is healthy and the interest rates stay high, I have no problem because the high NOI will compensate for the higher cap rates as a result
Hmm.
of high interest rates. And in the short run, of course, I still expect the interest rates to come down because of the Fed made it very clear their neutral rate is around 2.9%. Now it's a moving target, they can go up and down, but they understand the current interest rates are highly restrictive. Inflation is been coming down, and they are concerned not to put the economy into recession. So
Hmm.
the chances are they will likely continue what they've laid out to as a sort of, if you want to call it preventive medicine, you can call it preventive medicine. If you want to call it already
Hmm.
dealing with the potentially increasing unemployment, they're likely to do that. So in the short run, I see tailwind for the next, let's call it year and a half, 2 years. Long run, U.S. has entered a period of probably increased inflation because of the higher deficits, because of there's no more fiscal responsibility. So the printing press will continue to work and it'll continue to support inflation. So
Hmm.
if inflation is at elevated level on a long-term basis, I don't mind if the interest rates just don't do the yo-yo thing and they stay a little bit higher, that's fine. They will still be fluctuating, just don't fluctuate the way they did here
Yep.
from a zero interest rate policy to 5.5 that fast. That's my observation.
Yeah, no, I appreciate that, and I guess a question about some of these opportunities, more specifically around the strategy of the sponsors and bringing mezz debt in. Is it a lot of time? Is it in lieu of doing a capital call, or is it what you've seen a lot of times? Capital call is unsuccessful. They might not be able to. Maybe they get some additional capital from their existing equity base, but ultimately not enough to achieve their end all objective. Is that typically how this plays out?
Yeah, exactly. Kevin, you got exactly the right view. So you've got two possible scenarios with you. Some people try capital calls and then they don't work. I've
Hmm.
had people on my podcast who I've asked them, how much have you tried capital calls? What's the industry standard participation rate? And it's pretty lousy. I
Yeah.
heard 30 to maybe 35% on average. Past investors are just not happily writing another check, no matter what you tell them. They just don't. Some people will write, but that participation is generally not very significant. Not only that, most of the time sponsors have to lie to get investors to give them a check. Literally, they have to come up with a bullshit, pardon me, story. Either they scare the living Jesus out of people saying, hey, if you don't participate, we're going to dilute you to nothing. You're going to lose all your money.
Yep.
Or they say the picture is very rosy. I've seen these things. And you look at them and you say, wait a minute, these numbers just don't look right. So many investors have participated and they regret. So capital calls generally just fundamentally are wrong and they don't work.
Hmm.
And either sponsors come to that conclusion immediately or they come to that conclusion after trying, right? So what's the alternative? The alternative becomes this. If the project supports additional capital from existing investors in the form of mezz or member loan, or new investors in the form of a mezz loan or new preferred equity because the project actually has sufficient, let's call it sufficient existing equity, just equity rich, cash poor, or something like that, where there's
Hmm.
enough, the property justifies uh, additional capital. And the new money and the existing investors can get comfortable giving fresh capital in, but they are in a different position in the capital stack. That's the key message. In
Yep.
order to protect the new money, not to put good money after bad money, you have to be in a better position in the capital stack. That's the whole holy grail of the whole exercise.
Yep.
You have to put this money ahead of all previously invested money. As much as people want to protect their previous money, wonderful, participate. Let's go at them as loan. Let's pay you a strong rate of return on the new money. For those who participate, you get great rate of return and you're helping previous invested capital. But if we don't get enough from existing investors, we can go to external folks and raise it from external folks. And we've done that. And we've seen both existing people participating and external people participating. But if they're participating as a mezz loan in a great position on the capital stack, you have easy time raising capital. It works. That's the
Yep.
simple thing. It works for the project. It works for investors. And past investors going to say, why the hell do we want to pay 20% interest rate to the new money and a couple of points and even forgo a little equity? Well, here is the issue. If you don't raise the capital, the bank is going to put you in default. Why? Because they want interest reserves for the next 2 years,
Hmm.
and your loan hit some technical covenants that they can put you in a default. What do you want to do? You want to work some now with bank, or do you want to lose the asset? And most of them, of course, they want to work something out. Well, then you come up with 20% money. It's expensive, but on a relative basis, think a little bit. See, if you had, just using an example, $20 million previous equity and a $4 million fresh mess, just for sake of the simplicity, and the mess costs you 20% for 2 years, right? So you're paying 40% for $4 million, right? 2 years at 20%. So it's 3.2 million of interest cost. Sorry, not
Hmm.
3.2, 1.6 million, 40%. 1.6 million. So you just added 1.6 million of cost to the project, but it's relatively speaking
It's,
minor
it's
difference. It's not
small.
a
Yeah. Yeah.
small,
Yep.
but you enable the project to finish and sell in a different market. So the cost of money is relevant, but on a grand scale of things, if you don't do this, your risk reward ratio, it's very, very healthy to do this. That's the whole point.
Hmm.
Now, this doesn't work if your property dropped in value 25, 30%. If you are in the Sun Belt region and you are in Phoenix and the market corrected 25, 30%, you have no equity left.
Yep.
So you can't get messed up because investors going to come in and say, I'm not paying, I'm not coming
There's
in
no
and
room. Yeah, there's
exactly,
just yeah, there's no
exactly.
room. So I guess just to I'm sure a lot of folks that are listening, just the average retail sophisticated investor probably see a lot of a lot of debt opportunities, debt funds that have kind of come out over the last year or so. And I think what a lot of folks don't understand this is part of the strategy we're talking about here. A lot of groups maybe they've gone the capital call route and it just wasn't successful, but or they're like, well, this is just the better strategy. This is better end solution and more of a chance that we're actually going to get the funds that are necessary to kind of carry this project forward. Is so a lot of groups are just creating their own internal debt funds and raising capital at these types of preferred rates. And so I don't think a lot of folks have put two and two together. That's what's happening. There's nothing wrong with that. It's a great strategy, but it's a way to just be proactive and be able to save some of these projects that are great projects, have great fundamentals, they're great markets. They just need a little bit more capital to help them, survive through the next couple of years and finish up whatever capex projects or improvements that are taking place. So, no, that's very helpful, Mike. I appreciate the additional clarity there and insight. So let's talk about your crystal ball, right? I don't know. Mine hasn't worked, most of the time. Sometimes it does, but let's talk about it. I want to more specifically talk about after this. The election would have already happened by the time this releases. So we'll already know when you're listening to this who the actual, who the next president of the United States is. But for the purpose of our conversation here today, just would love to hear your general sentiment, whoever you might be voting. It doesn't matter. I don't care who you vote for, but what do you think happens? What are some major changes that you foresee occurring here over the next 6 to 12 months post election? Economic changes, that is, economic changes.
And I appreciate that. And the usual disclaimer, my crystal ball broke and I can't find another one for sale.
Yeah.
We've heard this rodeo before. So the good news is, again, by the time the episode comes out, this election will be over. At least we will have the stability and predictability of knowing who is the new sheriff in town, whether you
Yeah.
like the sheriff or not.
That's right.
For real estate purposes, being a real estate investor, I want bonus depreciation back. And I want a president with more sensible view of the world. When I came to the country, I was more old-fashioned, traditional, let's call it. I'm just going to be the America I saw before. I want that America back.
Yeah.
So, what some of the things I've seen recently really bother me. That a lot of crazy stuff. Boys and girls bathroom. Are you a boy or a girl? Or some of this stuff is insane. Like you go to
Yeah.
this stuff, it's like, who comes up with this craziness? So all that aside, I want the bonus depreciation back. Of course, I want smaller government, a little bit more business-friendly environment, right? But what I want is irrelevant, right? I don't know what's going to happen. What's going to happen is this, right? If you think about this. So let's talk about scenario. If Trump wins, it's going to be bonus depreciation back, more help for real estate, probably a little bit more fiscal policy,
Mhm.
fiscally responsible policy, maybe a little bit less government spending. So we're going to see probably Trump, even though he's not supposed to interfere, but he's probably will interfere with the interest rates. He's going to push for the rates to go lower faster. This is sort of
Hmm.
my view of the world because he's a real estate guy. If Kamala wins, we're going to have more open border. We're going to have a little bit more creation of aggregate demand. More people need to live somewhere. So she's going to let more people into the country. And ultimately, there's going to be greater demand for housing units, whether you like it or not. So
Yeah.
we're already short, and there's going to be even more. And I don't know how they're going to solve it. It's insane what's happening from the school systems being overloaded, hospitals, healthcare, but it'll also increase population. And what's really interesting is this point is that all that population growth, US actually needs more labor. So
Hmm.
if somehow these folks they enter labor force, whether documented legally or illegally, it'll actually help curb inflation to some degree, in theory, if they're working. So we're talking about all kinds of possibilities, but one way or the other, once the election is over, I think we're going to see probably a more of a real economic slowdown
Hmm.
because the election spending will disappear. So you'll have election spending going away. So some level of further slowdown in the economy, deceleration, maybe some more cooling of the inflation, further interest rates reduction. That's quite an immediate short term. Long term, honestly, U.S. has entered a period of large deficits, and I don't know what the solution is. The solution
Hmm.
is either bring the rates down to very, very low interest level like Japan, maybe even turn them, I don't want to call them negative, but very, very low. And so you can afford that service. And I don't know who's going to buy U.S. bonds. We
Right.
already saw this. Foreign central banks are not buying U.S. Dollars as a reserve. That has already taken place. This is, by the way, one of the really fundamental shifts is that foreign central banks used to keep dollar reserves. Now, look what happened to gold.
Yeah.
There's been a lot of gold purchases to move the reserves outside of dollar into something more tangible.
Hmm.
So we'll see. But the Fed
Yeah.
has, and I've said this before, who's more powerful, the President of the United States or the Fed chair? In my view, is the Fed chair. The Fed
Absolutely.
chair has the printing press, and they can apply a form of quantitative easing. If they need to move the rates down, they can through essentially monetization of U.S. debt to the degree that they need to monetize it.
Yeah, no, I appreciate that. And again, by the time this comes out, we'll know, but only time will tell, right? It would take it some time for it to kind of shake out, ultimately see what type of policy changes are implemented here over the next couple of years. So, but at the end of the day, Mike, I mean, generally speaking, the fundamentals. I mean, as we talk about real estate investment, while strategies have to change, you have to kind of duck and weave and adapt accordingly. The basic underlying fundamentals don't typically change, right? And so, I mean, if you're willing to, you know, to make shifts in strategic manner and you're a disciplined investor, time typically will heal all those wounds. Would you agree with that?
Yeah, absolutely. So what we're referring to also, the political landscape in Washington is not really going to impact local dynamics the way people overthink, right? So it's much more important to have the right local elected
That's
official.
right.
The second thing, of course, the interest rates is a global thing. That's one thing, at least, or not maybe not global, but U.S. wide. I wish you could keep interest rates low in one region and high in another region, but it doesn't work that way. So that's, by the way, that's one of the curses of a central bank is that monetary policy is just for the entire country. And it should be very much regional, and the interest rate should reflect regional dynamics. In some parts of the country, I wish they were higher. Some parts of the country, we wish they were lower. But at the end of the day, fundamental investing is what's going to matter. So
Yep.
all these strategies we talked about, they actually still fundamentally very, very solid. Folks have asked, this strategy we just described with mass debt recovery capital and many of these projects, it actually applies to the new deals. What's really interesting is we've done some new loans on new construction projects. We funded a bridge loan on built-to-rent community in San Antonio, ground up. They were a little short raising capital. We gave them a bridge loan. So the strategy of a small mezz debt or small preferred equity layer has worked in the past, but it'll probably continue to work.
What I guess usually I'd love to, if you wouldn't mind, just let's talk to that one real quick. So new ground up development, what percentage of the capital stack did that mezz debt consist of? Just curious as to like proportionally speaking.
Yeah, so there was I'm just going by memory. I would have to pull it up.
Yeah, no worries. Yeah, I
Maybe
won't hold you to it.
maybe about 5% behind a bank loan. So the bank loan was like at 65%. It was tight. So
Uh-huh.
we gave another 5%, and then the rest was equity, but they were a little short to raise. So we gave them a bridge to carry the weight. So the mezz debt in the form that we do, we are not trying to provide large portion of a total capital stack. Five, maybe you can go to 10% of the capital stack behind a bank loan of, let's call it 65%. The rest has to be a real tangible equity. So we like ratio between, let's call it mass debt to the existing common equity to be 20% of the 30%. In a
Hmm.
traditional sense, we've seen deals where brand new deals on a new acquisition, and we've structured them. We actually like them. You can structure half preferred, half common. I've even seen 60% preferred, 40% common. You can do that if you buy right, right? If you buy right,
Hmm.
at the right price of fundamentals, back to fundamentals. If the
That's right.
fundamentals are good and you want to maximize tax benefits to common equity and provide liquidity and more cash flow, not liquidity, but more higher cash flow to preferred, you can do that. We've done these deals. You shift the cash flow from common to preferred, give preferred higher yield, and then common take the tax benefits and higher upside.
Hmm.
You could do that. These ratios, there's no right or wrong. Today, on the recovery front and on a bridge loan front, because the conditions are very tight, we're coming in only with a small portion. But on a new deal, if we feel great about the deal, 50-50, 60-40 ratio is totally fine, both ways. Either way, 60 common, 40 preferred, or the other way around. These ratios have existed and can be implemented properly as a way to provide capital, because they're investors who want higher safety, no matter what. You just want
Yep.
higher safety. So you want to be in preferred or mass debt. You don't want to be in common. That makes you feel better at night. And they're investors, both you and I know a million of these people. They're all real estate professionals. They want higher tax benefits. They don't mind a little more risk exposure. So
Hmm.
if the risk profile is higher, they're happy to go in the common while some other taking the preferred part of the capital stack. And I'm using preferred and common interchangeably. So you basically have to do preferred if the primary lender doesn't allow secondary loan, right? You have to call it literally something else. You're not calling it debt. You can't call it debt if the lender will not allow you, will violate the covenants of the first lender.
Hmm.
So it can be called preferred equity, but it could have a fixed coupon. It can act quack, look like debt, right? With the yield, but it could also have some elements of upside in the deal too. You can have a current coupon plus an equity upside in the capital stack too. So we've seen plenty of those deals, and I actually see a ton of opportunity ahead, but it starts with a great deal. You have to find a
Yeah.
great deal as the next step. which is not easy to find, as crazy as it
That's
sounds.
right. That's right. I mean, it goes back to being disciplined, right? Like you just, there's not as many deals that are, if you're remaining true to yourself and your business model, there's just not going to be as many deals that check all the boxes, right? And that just goes back to being disciplined and knowing that there's opportunity. It's just, you might have to, sift through, 3X or 4X the amount that you had historically to find one that truly checks all the boxes. And I think also just another point to make here to summarize some of your great points is that, you, you know, you and I, groups like ours remain relevant because we seemingly find solutions to complex problems. Like we make money as real estate investors by solving complex real estate problems. It was easy, just years back when rates were low. I mean, it was easy to seemingly make money. And ultimately what happens a lot of times is the folks that can't get creative, they can't think outside the box, are the ones that, just either find another line of work or go a different direction, or maybe they're just not active at present time. But there's always opportunity out there. I mean, you're finding opportunity, we're finding opportunity, maybe not to the degree of what we had years past, but it's still there if you're willing to look and you're willing to get creative and come up with creative strategies. So it's all about finding those solutions to complex problems. I'm a firm believer in that. And look back historically, there's always somebody making money depending on what whatever the real estate cycles do, whether it's up, it's down, it's flat, it's peaked, whatever it might be, there's still an opportunity to make money. So
Let me
with
add
that,
this comment.
yeah, yeah,
Yeah, I know we were probably running out of time, but I wanted to add one more quick comment. I agree with that wholeheartedly, that we actually get paid to solve problems. Ultimately, that's one of the most important skills is ability to solve problems,
mhm,
especially complex problems. Solving easy problems is easy. And the other final point is opportunities now actually better than opportunities a couple of years ago. Most
that's
people
right.
don't really understand this. A couple of years ago, people were doing momentum investing. Everything worked. You just kept following the momentum and until it stopped working.
The rising
Today,
tide, right? The boats aren't being lifted
yeah,
anymore. Until we're back then.
today it feels like environment is very different, but the opportunities today are better than before. The crazy
That's right.
part is because you actually have some level of distress, dislocation with what was created with these higher for longer interest rates and other issues in the market. So the deals that actually get funded are usually better deals today than they were a few years ago.
Yeah, no, great point. I mean, we literally 2023 was probably our best year, and it looks like 2024 is going to turn out to be potentially even better than 2023 as far as great opportunities at discounted prices, but being able to buy them at a time when other folks aren't. There's not a lot of liquidity flowing around, and a lot of investors are gun shy. LPs are gun shy to put more money into deals. But ultimately, it's been a great year. Great, really 2 year run for us. But then again, we didn't buy a lot in late 2020, 2021, 2022. We sold quite a bit of properties, just taking advantage of some peak pricing. And again, I didn't have a crystal ball. I just knew that if we just remained disciplined. There's so many deals that got frustrating at times because there was more capital trying to work its way into the market, and we were turning investors away. And a lot of times we had investors that they took their many times, right? They took their money somewhere else. But we just had a challenging time making deals underwrite, and again, frustrating because you've got the capital, you've got the resources, but ultimately the deal flow wasn't there. And so today's I think it's a slightly different shift, right? There's more opportunities, but just not a lot of liquidity out there that can that can you come to an amount large enough to actually take down some of these deals that present themselves. So it's been a great 2 years for us. I'm excited. I mean, I feel good. I sleep at night because of it, and we've continued making distributions quarter after quarter. So it's been a good run for us. So, but I agree, there's a lot of opportunity out there. You just got to have the wherewithal and the problem solving skills. I think more than anything else to get deals done. So, Mike, this has been a lot of fun, my friend. I look forward to always look forward to the conversations. Look forward to catching up at a future date as well, and crossing paths hopefully at Freedom Founders here in the coming months and years. But for those that want to learn more about you and your group and what you guys have going on at the present time, where's the best place to track you down?
Thank you, Kevin. Appreciate the wonderful podcast, and again, really love to hopefully see you more often at these
Yeah.
events. But the easiest
Yeah.
way to find is bigmikefund.com. And our corporate site is tempofunding.com from the word temporary, TEMPO, tempofunding.com. Feel free to reach out. Happy to chat. And yeah, we'll see. We'll see
Awesome, my
where
friend.
the
Yeah.
journey goes next.
That's right. Exactly. Exactly. I appreciate it, my friend. You take care. We'll talk soon. Okay.
You too.